Welcome to Magic Indicator Strategies. In this short video, we will present to you a game-changing ICT fair value gap trading strategy that will make you thousands of dollars in profit in the long run. This strategy is based on only one easy-to-read technical indicator that not many traders know about. This free TradingView tool is called the ICT 2022 Mentorship Model. It was created by Trade4Op. Add it to your favorites so you can find it easier in the future. This indicator is multifunctional. It displays structure breaks, liquidity taken, fair value gap candles, and buy and sell signals. If some of these terms sound complex to you, don't worry. We will explain everything you need to know about the ICT fair value gap method in a second. Traders, if you're enjoying the content, hit that like button and subscribe to the channel if you're new. At Magic Indicator Strategies, we share some of the best trading tools and strategies to turn you into a pro as fast as possible. The ICT, which stands for Inner Circle Trader Fair Value Gap Trading Method, is a forex trading strategy that aims to exploit temporary imbalances in currency prices. In simple terms, it works by identifying gaps, or differences between the perceived fair value of a currency pair and its current market price. A gap occurs when the market price of a currency pair is significantly different from its fair value. This can happen due to various factors, such as news events, economic data releases, or changes in market sentiment. The idea is that these gaps represent temporary imbalances that are likely to be corrected over time. Once a gap is identified, we need to determine the direction in which the market is likely to move in order to correct the imbalance. If the currency pair is undervalued, the expectation is that its price will rise to reach its fair value. Conversely, if it's overvalued, the price is expected to fall. The indicator spots such price imbalances and colors fair value gap candles in yellow. It also plots bullish and bearish fair value gap zones, which are likely to be retested by price in the near future. When the retest does happen, the indicator prints buy and sell labels that can be used for entering long and short trades. The structure breaks are these green and red dotted lines that appear when the market structure is broken. For example, when the market breaks below the most recent low, a bearish break in the structure is present. This could be an indication of a market momentum change. On the other hand, when the price rises above the previous high, a bullish break in the market structure occurs. So based on what we've just learned, how exactly should we use this ICT fair value gap indicator for finding high probability trade entries? Well, here's the strategy we suggest. For a signal to sell to be valid, we need the following conditions in place. First of all, a bearish fair value gap must be present in the market. The price must return to it for a liquidity grab. When such a retest happens, the indicator will print a sell signal. However, we cannot take a short trade yet. The next condition is to have a bearish candlestick formed with its closing price below the fair value gap red zone. The signal should be skipped if a bearish candle does not form and the price exceeds the fair value gap to the upside. If the rules are met and we have a sign of bearish sentiment in the market, draw a demand zone to find out whether there is enough room for you to make a profit. If the price is positioned very closely to the demand zone, no short trades should be taken. It's simply not in your best interest to sell at a price where there are high concentrations of pending buy orders. Enter the trade only if there is plenty of room for the price to move to the downside. Place the stop loss at the recent swing high and target the next demand zone. Once the price has moved in your favor, adjust the stop loss to the break-even level. Alright, now let's find some trades we could have taken with this strategy on Euro against US dollar on the 5 minutes time frame. So here we see a signal to sell. A bearish candlestick was formed, however it wasn't closed below the bearish fair value gap red zone. After that, the price broke above the gap. In this case, we should have skipped this trade. The next sell signal has a similar scenario, except that the bearish candle bar wasn't formed at all. Another losing trade that could have been eliminated. Our next example shows two signals to sell, one of which has been confirmed. I'm sure you've been following along and can easily tell which one that is. It's this one right here. A signal to sell was printed on a bearish candlestick that retested the red zone. As a result of the candle bar closing below the zone, the entry has been confirmed. Next, we draw a demand zone to determine our take profit target. The trade could have been successful. The next short signal is a very bad one, but it could have been avoided as it appears exactly in a very strong demand zone. Same thing with these two signals right here. The conditions are simply not met. This long signal is also not the best one, as the closing price is near the supply zone. Even though the trade could have been a winner, we would have avoided such a signal for safety purposes. Okay, let's move on and find some more examples so you can fully understand the strategy. This next sell signal was a clear winner. All the rules were in place. These three signals were false, and we would not have taken them. I hope you understand why. Traders, if you follow the rules we just told you, you will be amazed at how well the strategy works. You don't need a bunch of fancy indicators on the chart. This strategy works very well for Forex. It's suitable for all major pairs. You might think the indicator only finds profitable sell entries. This is far from true. Just take a look at this trade it found not long ago. Notice how strong the selling pressure was. The market broke all the major demand zones, however it eventually found support. A strong bullish candlestick was formed, signaling a start of a bullish trend. The price retested the fair value gap, and the indicator printed a buy signal. We can see that there is plenty of potential profit to be made on this trade, as the price is not anywhere near the supply zone. So we follow the rules and execute the trade. Alright traders, I hope this video was helpful. Give this strategy a try, but backtest it first. We recommend Trader Edge for backtesting strategies. With this app, you can backtest and forward test any trading strategy you can think of. No experience required. You can start as a complete beginner. Trader Edge will even provide you with a free backtesting guide and a course about how to build a sustainable trading strategy from A to Z. Moreover, on this website, you can find indicators and trading strategies that have been backtested and proven to work. So sign up for Trader Edge today and become a better trader day by day. We will leave a link to it in the description of this video.